About how this year feels compared to previous years. We're hearing so much about the buzz in private markets. Are you noticing it on the ground?
Yeah, I mean, there's obviously a large attendance here this year compared to prior years, which leads me to believe that people are interested in what they should be investing going forward. So I think that's been the topic of the day here.
There is a lot of debate right now around the U.S. fiscal outlook. Just this morning, we were talking about Elon Musk speaking out against President Trump's big, beautiful bill. We know the bond market has been concerned about what it means for the fiscal outlook. What's your take?
Well, I think, ultimately, if you kind of step back, tariffs have been sort of the headline for the past, several months here. But if you really step back and think about the major trends that have been driving the economy over the past several years, there are really three things that came out of COVID. One is you've seen massive reshoring of critical, supply chains back into, the United States. You've seen a redesign of supply chains as a result of that. And then lastly, as you mentioned, we've got these persistent deficits in the United States. And that is driving, the level of interest rates, where the global economy is going. And I think it's those trends that we have to look to going forward as it relates to how we think about investing and what that means, obviously, for the economy going forward.
Have you changed how you're investing, where you're investing as a result of the volatility, the uncertainty that's been introduced since President Trump's come to power?
Yeah, look, I would say with tariffs, that does create a little bit of uncertainty, but I think this too shall pass. I mean, we'll eventually have some certainty on tariffs, which are effectively a tax, ultimately. And it'll just be another input to our underwrites when we think about how we assess risk. It's ultimately these prior trends that I think we're looking at. And as we think about investing on a global basis, I think we still see good opportunity in the United States, especially at the very top of the capital structure in terms of, first lien lending. In Europe in particular, since we're here, we've seen a lot of great opportunity, and we think we can pick up actually greater, returns here relative to the risk that we're taking in the United States, or in the United States, if you will. And then finally, we've been looking at a lot of non-sponsor transactions. As you know, sponsor activity has been really slow over the past 12 to 24 months, and for us, we've been able to pivot to that non-sponsor activity. And then thirdly, which is, I'm sure, talk around here quite a bit, is asset-backed finance. And that opens up a whole new area for investors in terms of how they can put more credit into their portfolio, but diversify away from single-name corporate credit.
There is some concern that there's too much capital chasing too few opportunities, and as a result, we're going to see more investing in lower quality companies with higher default risk. What is your response to that concern?
Yeah, I would say a couple of things. One is, I think it depends on what area you're looking at. There certainly are certain pockets where you could say there's maybe excess capital relative to the opportunity. But when you look at the broad, private credit, market, if you will, which I think is more broadly defined when you bring in the investment grade side to over 23 trillion, I think there's a lot of opportunity there. But there are certain segments for sure right now that seem to have excess capital relative to supply, but that'll even out over time. It always does. I've been in the business for 35 years. It finds itself through, if you will.
Another concern that's circulating from the regulator community is around the interplay between banks and private credit. Banks increasingly lending to private credit funds. And obviously there is an issue around the opacity of private credit, given that it's not subject to the same type of scrutiny that public market investments are. What is your response to the Fed, to the ECB, who's increasingly worried that if we enter an economic downturn, we could see all these layers of risk exposed and ultimately leave the banks exposed? Yeah.
Ultimately, private credit is just part of the overall financing ecosystem. I think when you have a healthy ecosystem, that's good for everybody in terms of overall liquidity, if you will, in the marketplace. And private credit is just a component of that. I would say, we're there to help borrowers achieve their objectives, and whether we do that in private form or it's done in the capital markets, I mean, it's still the same objective, and credit is credit. I think from a regulator's perspective, 2 points. One, BDCs are regulated by the SEC. They're 40 Act companies. I'm a former board member, so I know there's quite a lot of oversight with respect to that. And I would say banks interplay with private credit. Those banks are regulated. We're very transparent with what our positions are that they finance, and presumably the Fed has oversight in terms of what they're lending to. So I would say that the regulators probably have an insight into what we're doing if they want to.
Okay.